And that kicks off the hard to believe, but March 2025 AMA. Thank you all for being here and a part of this. We have a bunch of awesome questions as always. So, as I said before recording, some big news in the sense that this Friday we're going to probably be releasing the Android app. Then we also have an AI bot for paid users coming on the way. So a lot of good things in store. We're still releasing a ton of video content. And well, George, let's just kick it off. What's the first question we want to tackle?
All right, gentlemen. First question we've got here is the market going to go further down? Just kidding. That is not a legitimate question. First one we've got here is from Beck. And I think Beck had a couple other questions that Lance answered directly in the Ask Me Anything channel, so just review that. But he had mentioned on February 19th, 2025, the PLTR waterfall. How and if should it have been played? Trump announced 8% cut every year for 5 years to Pentagon, causing this waterfall.
Yep. So this dating reference is the 219 crack here, February 19th. We are in Palantir. Let me throw that intraday up. So this one was kind of interesting just because the truth is, like, this headline wasn't really that new. Like, this had kind of been out there before. But I think what happened was just because Palantir was so run up, look what we had been doing on that daily. And keep in mind, this was also the day that SMCI was going nuts as well, where SMCI had gone from 40 to the high 60s. And so what ends up happening is, there's, I think it was Washington Post. Washington Post was the original headline. And it really didn't even like move a ton initially. But then I think what happens with some of this stuff is like this just catches momentum. And along the theme that I had been mentioning of the so-called kind of just thesis buster headlines, like Palantir had been going on this belief of just like, oh my God, like AI and growth stocks and high valuations to the moon. They just go up, 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 up. And so a lot of Palantir's revenue is from the US government for defense contracts. And so the Washington Post article, which again, I don't think it was like so particularly groundbreakingly new, but they said that the Pentagon was going to be cutting some of their spending for some of just the deficit cuts. And what started off pretty slow, then really caught momentum, and then really melted. And so I think a lot of times what happens is when a stock is so run up like this, this stuff can become that feedback loop where you say, oh my God, is this it? Is this it? And very similar timed, the SMCI, Palantir, I think, kind of led it. Then SMCI started to crack as well. And I think a lot of this was just, I mean, look how similar this rollover was to Palantir, when of course SMCI has nothing to do with Palantir fundamentally, right? They're totally unrelated companies. SMCI is of course the racks for some of the computing and AI chips. So no real direct connection, but it's just that these were so run up. And here's the thing, like, you don't, and this is why it's so important. Like, you don't want to be an analyst and you don't want to just be like, oh wait, this news was already out, or we already kind of knew this, and start fighting this. When this stuff cracks, it can be very strong, and a lot of times this stuff doesn't bounce. And I also think a lot of this is a role of just like, a lot of options are traded on stuff like Palantir, the SMCI, and all of that then kind of once it starts to implode, the momentum just really builds on itself. George, what was the specific question around that? Did I answer that well? Can you repeat the original?
Yes, it was basically how and if it should have been played.
Yeah,
So
got it. So
has it
how and
played?
if? Yeah. So the one thing that I want to say is like, I think a lot of people I know didn't really crush this headline just because like if you're following some of the news very closely, this wasn't so particularly new. But what I do think is you just don't want to be fading this. And like, so maybe from a technical perspective, if you're going to hop on somewhere, like if you can get it at low of days, below this, at low of day, below this 121.50 or so, like, I mean, it's already gone a couple points, so it's a little bit of a chase. But like, okay, maybe you do something like that, and this actually trailed prior bar highs on this 2-minute chart super, super well. So maybe you're able to get that, catch that whole leg, which is, would be amazing. But like the way this news was disseminated and the way this started to crack, I don't think this one was particularly easy to go with the trend on. Um, and even for this short later on, here's what and we're close to the close, but what I really would have loved to see is if this makes this big leg, we can't really bounce and we just consolidate, 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 then we cracked. But this specific rollover here, it's not really enough consolidation. So for those of you that have watched the recent videos on consolidation, you'll recognize that I talk about really wanting ideally at least like a one to, in an ideal world, I want a 1-to-1 ratio. So this is kind of the size of the down move. I'd want to see it consolidate then kind of a symmetric, I don't know, at least an hour, if not more, over here before I wanted to short that break. So this consolidation, way too little for me to be so intrigued and into this. So in conclusion, like I definitely don't want to be buying this. Like once this momentum cracks, it can crack really, really hard. But I also don't think the short was so easily captured either. Like yes, it went to zillion points. Yes, we kind of gap down the next day and melt from there. But the other thing too is like the whole market and just overvalued stocks in general then started to implode as we've seen kind of continue so far. So yeah, I don't think this you can beat yourself up too much over this one.
Yeah, and then next one they had was March 11th, Tesla, and they put 10:48. I'm guessing that's the time.
Yep. So okay.
Um,
So I think we all know. Oops, I'm on the wrong day. Oh,
break
I
of
got to send the file.
220.
Oop, oop,
He
oop.
said, was that okay? He said, was that a liquidity grab at 10:48 on Tesla and a sign of reversal?
And was this you said 311? You said
311. Yep.
311. Um. Oops. Oopsies. So let me see. 311. So we saw that daily chart just for context. I think we all know the story, right? Oh my God, Tesla and Trump are going to save the world. This is so good for Tesla. Everything's great. Economy is amazing. We get a little bit of blow off top. Then we really start to crater as all of a sudden it's like, oh my God, Tesla sales are just plunging around the world. And then, of course, the overly inflated stocks, a lot of stocks that were running super expensive also got crushed. And the Qs got crushed. And I mean, Tesla really is taking it on the chin. I mean, we're talking like this stock is down over 50% from highs. We had a very large volume day on the 10th, the prior day. And this 3-10, this was the most capitulatory day overall, um, which is important to note. And what's also important to note is uh, in the overnight session, or maybe it was after hours, we got as low as 210 or so. Then we really aggressively rebounded into the morning. So all those signs are good signs of a bottom. So that being said, let's now look at this intraday with that context. Um, so about like 220-ish or so were the lows from the prior day. And so this, we open about flat, we drive higher, but then if you recall, there was right around here, like I think 1020, maybe it was around here, somewhere around like 1015, 1020-ish. There was another Trump headline where Trump was saying they were going to, he essentially was an aggressive tariff headline up. We're going to increase tariffs even more. We're fed up with this. So then the whole market started to sell off, and that brought Tesla to lows and even below the prior day lows, which had otherwise been holding up pretty well. Um, So interestingly, we break below the prior day lows, then we reclaim. So like, I mean, I don't like to use the term like liquidity grab. Like, what does that really mean per se? Like, I don't. It's just a vague term that I don't know if there's even like a really agreed upon definition. And like, it's not as if there was like so much liquidity. You know, it's the volume wasn't so crazy anyways. But we do end up breaking down and immediately reclaim quite aggressively. And so, do
Yeah.
I think this can be a sign of a reversal? Like, yes. I think more important than this intraday, like the way more important part is the context of this daily chart and the prior day. So going back to the prior day, one other thing I'd add, and this is what I was referencing, the overnight price action, where we got as low as 210, then aggressively reversed. But one other thing is this closing bar was enormous volume. And I always like looking at this. But like I think Tesla most days on the closing print had been averaging like couple million shares, maybe 2, 3, 4 million. Then this day we ended up just puking over 9 million shares on the print. And like 9 million shares of Tesla is a super large amount, obviously. Um, so more interesting to me than that intraday was the fact that like this 3-10 day was the most capitulatory day thus far on the daily, and the volume really accelerated and that closing print. So I do think that probably was some form of liquidation of someone. And then once we kind of the next day go to lows, then we reclaim. I do think that can put in the foundations for a bottom. And sure enough, like, you know, this wasn't so convincing, but once we kind of closed above, I mean, like pretty above 230 and pretty close to highs of day, um, I do think that was kind of the sign where it's like, hey, bottom might be in. And if you're gonna swing this stock, I do think you know, if I had to overnight it one day, that probably was the day to go for it, given those factors. You know, Tesla, we had a nice gap the next day. But then for me and my system, I would have been stopped out below 240 anyways. So it's like that wouldn't have really worked out so great anyways, but I do think it was worth it. I easily could have seen a world where this got, you know, into to 270 or so on a nice swing. So yeah, I think all those are interesting things to think about and how I kind of see that.
Yeah, very nice. Um, Moving on to next question here. We've got Edward Lung. Um, said, "Hey Lance, just want to ask you how much you weigh the overall market's price action versus the ticker's price action when considering taking a position. If the market wasn't behaving properly, but your ticker was, would you still take it?" And then he
Yep.
says, for example, late last week on the close of Thursday, I was spooked out of taking a lot of longs that were setting up well because of the weak close in the indices. How do you navigate not having, or how do you navigate having to base your decision on several charts? I assume it would be even more variables for tickers that follow commodities in the indices.
Yep. So here's the thing, and I actually I had got asked the same question at the Traders for a Cause meetup last Thursday, and I know some of you in on the Zoom were able to attend. So like that was super awesome getting to meet you all and getting to chat. So thank you. If you don't follow some of the Traders for a Cause stuff, people, these meetups are just such amazing places to form a pod, to talk to really great traders. Lucas the Short Bear was there. We had a lot of Trillium guys there. We had SMB guys. So highly encourage people to attend these things. They are really fun and they're good networking. And so this same exact question was asked of me in person. Just coincidence. I don't think it was the same person. But so in general, for the most part, I tend to be trading stuff that is moving idiosyncratic from the market. Um, Meaning most of the time, most of my trades just don't really have a high correlation to the market. You know, it's like if let's say there's an IPO. If I'm trading an IPO that day, it's really not going to trade with the market. If something is fresh breaking news on it, it's really not going to trade with the market. And most of my stuff doesn't. That said, stuff like the Tesla, like if you're trading Tesla, this definitely is trading with some form of correlation that's decent to the market, right? We can see this whole pattern be, decently similar over that time frame, right? Um, so what I would say is like if you're trading a market stock, meaning it's a stock that has decent correlation to the market and is going to be moving with some correlation to it. I do think you need to start to weight the market action a little bit more. But I would say overall, I'm not really paying that much attention to the market because most of the stuff I want to trade is moving separate from it. So, take something that's been ripping like the QBTS, right? Like this stock, of course, they had that little research paper. Oh my God, like our quantum stuff is so good, even though it's still probably a zillion years away and ridiculous. Anywho, um, like on this super strong close, uh, like this stock, this stock is not really going to move with the market, in my opinion, whatsoever. Like, even if the market was down like 1% overnight, I could still easily see this stock gap up 8%. Trying to think of another example recently, but or look, what was it today? The G triple R, the G triple R had the Citron today. Like this is moving idiosyncratic from the market. If this mega puked or something and I was considering a long in it, I would not at all be weighing the market. So I hope that helps. I guess, the TLDR is in general, I'm trading stuff idiosyncratic from the market. So I'm not really weighing the market much at all. But if you're more in stuff like market stocks, like a Tesla, that have a correlation, of course, you then kind of need to factor it. But so here's the thing though, even with this Tesla was so much more beaten down than the overall market that if I am overnighting this on like 3-11, ideally this is going to move with so much beta with above the market if we're up. And even honestly, even if the market was probably flat the next day, I still think that Tesla, is probably good for a pop. So hope that helps. It's definitely a little bit of an art more than some exact perfect answer science.
Very good. Yeah. And yeah, Tesla, man, I think Lance has a great point about, you know, certain stocks do follow the market. And then it's a matter of paying attention how much they do or how much they diverge. Because I know, especially with a lot of the mega caps, on a day-to-day basis, like they're pretty much rolling with the market. But then when you see more divergence, like that, it's definitely something to pay attention to. And
Yeah.
I know Tesla, the last day or so, has started to be even weak compared to the market, which is kind of wild,
Yeah, and
given
here's the
how
thing
low it
too.
is.
Like there's so many people that are trading the indices. Like there's the people that are like, oh, all ES, ooh, trade the market or NQ or whatever. But here's the thing, like in general, I'd rather be trading the stuff that's moving. Like if the market is weak, I want to trade the stock that's just absolutely imploded. um like if we take the spiders, so the spiders have bounced about what, like 3% off lows. Rather, if I'm looking for a long, like why would I ever trade SPY rather than like Reddit? Right, like Reddit was down at like 103 or something, um off after hours and overnight on 3-10. So I mean that immediately bounced 30%, right? Like think about the asymmetry of buying something down there that then bounces 30% versus a spider which is bounced 3%. So I'm really looking for, if I'm doing mean reversion, I'm looking for the stuff that's just absolutely imploded, or I'm looking for the stuff that's held up the best and then breaking out. I mean, example of that, take Baba, right? Like this is, I either want a long, the strongest stock in the market holding up well, or I want to long the stock that is imploded and just totally bombed out, right? And I can't impress enough just how important what I just said is. So many people like will instead trade stuff in between, and they end up losing just due to stock selection. Even if the market kept going lower, yeah, I don't know. Like Reddit is probably not fully imploding, much more at a certain point, and you just get very asymmetric skew when you get these bounces.
Yeah, well said, Lance. Very critical point. Um, Next question here is from Timothy Lung. He says, "Hi, Lance. About the recent pump of quantum stocks, how would you take this mean reversion opportunity of these quantum theme stocks today? Pointing out QBTS, QUBT, QSI, etc."
Yeah, I mean, the thing is like the first question I would say is, so I mean, the leader is QBTS, right? I think that's all clear. This is the only one that's anywhere even remotely at highs. But it's hard because this is kind of the one being driven on news. So it's like, I don't know, is this necessarily a mean reversion opportunity? I definitely want to be somewhat careful. Like this is breaking out now. This does have huge volume. This does have a news catalyst. So unless this really breaks the trend, I don't want to be short this. Um, what is kind of interesting is, will some of these shittier ones kind of offer a retracement? Like, could we see this go back towards the top end of the range? Hopefully, maybe that would be cool. But the thing is like a lot of these are otherwise in mid range right now. So it's like, I don't know. I'm not really so compelled. RGTI's mid-range now. So, if this is the range in RGTI 6 to 16, like, okay, if you're short, you probably want to cover because we're towards the bottom of the range. But like, here's just the middle, right? 6 to 16, 11 is literally, but literally the middle. So I'm not really so intrigued or tempted for mean reversion in some of this stuff, because the leader is breaking out and I don't want to fight that. Then a lot of this stuff, I'm not saying I would be like totally opposed, but at least right now it's not setting up in a way for me where I have any interest. So my answer would be I don't personally have interest. If someone does something different, hey, great. Many ways to skin the cat, but for me, no interest.
Very good. Next question we have here is from Thomas Flauto. "Hey Lance, about the consolidation video from last week, could you give some examples what you mean with a small versus bigger preceding move?" Does that make
Yep.
sense, Lance? Okay.
Yep. So this ties back essentially to what I was talking about on this Palantir chart on 219. Let me see if I can pop that up real quick again. 219. I always say I need a little Vanna White or someone to help me pop charts up in a much more graceful manner. All right. So what I talk about in that consolidation video is essentially, if this is the preceding leg, call it from 124 to 112 or so, like, and I can, let me see, what do I have on here? Oops. Oh God. Drawing. So let me see if I can, I hate drawing on this thing, but let me try my best to not embarrass myself. So, let's call that the leg there. Oh, why is it red? Let's do that. Okay, so let's call this yellow line, gold line, or whatever, roughly the length of the preceding leg. Like what I mentioned is the consolidation really is way shorter than that. In an ideal world, oops, in an ideal world, what I really want to see is probably something like this. Oh, it's red. Hold on. Um, so when I said like a shorter preceding leg, let's say, for example, that this leg only went, maybe like 4, 5, 6 bars around here, then I might be okay with this type of consolidation. But because this was just such a big move, in just numbers of bars and distance covered, I really want to see this go further across. And so that's what I'm talking about as far as that preceding leg. Like a much smaller leg doesn't need as much consolidation, right? But think about this. I mean, just think about this logically based on the video. Essentially, consolidation is price acceptance. Um, like, how eager are you to short Palantir at 112 when literally 30 minutes ago it was 10% higher, right? That's a really big move in a short amount of time. And so a lot of people that are eager to short that might be saying like, oh, wait, I'm just going to wait for a bounce. And a lot of people that might not want to buy at 122 or 120, they're willing to buy at 112, 113, 114. So consolidation allows a lot of price acceptance. In other words, like people that are willing to buy get the chance to buy, and that people that are looking to short, they're waiting for the bounce, but the bounce doesn't come when we just consolidate across. So if I'm waiting to short a pop to like 119 or 120 and we don't bounce, we don't bounce, we don't bounce, we don't bounce, then we roll over, guess what? I need to then enter at this point because we haven't been able to give me the prices I want. So that's why, like, look, if Palantir only went 50 cents, like if we went from 124 to 123.50, who gives a crap? Like nobody's going to be like, "Oh my God, I don't want to chase Palantir down 0.5%." No one's going to think that way. But when it's fallen 10% in 30 minutes, a lot of people are going to say, "Oh wow, I don't know if I want to chase." So that's why consolidation is so important. Gauging the consolidation is important, and that's why I view it relative to the distance it's traveled, not just the absolute distance and price, but also over time. I think both those variables are what makes consolidation so important.
Hey, Lance, and Rajan just had a follow-up about that too. He said, um, in terms of consolidation, like sometimes we see we've got symmetric amount of consolidation. Other times we talk about to the MA. He says, is it fair to say that MA is the minimum requirement, but symmetry is ideal in terms of consolidation? Does that make sense?
I'd say like there's always going to be exceptions to any rule, but like as a general rule of thumb, like yeah, I would at a minimum, I probably want this to here. And yes, in an ideal world, I want it longer. And yes, and I do think I say that even in those consolidation videos, if people go back and watch those. So yes.
Nice. And then there is one other follow-up from Thomas Flauto said, this is a second question from him. If we have a good trade idea, but the tape is slow and choppy, is that a signal to skip the trade?
Yep. So that's a good question. So the reality is the tape for me is a factor in my trading, but if I had to guess in most trades as a general rule, not always, but in most trades as a general rule, I would say like the tape is maybe like a 5 to 10% factor. So, or sometimes it's like a 0% factor, depending the trade. So I would say like if the intraday and the daily are still very good, like I'm totally okay if the tape is slower or not that great or nothing so special about it. So it's the tape won't be generally a make or break factor for me, just a smaller one.
Nice. Very good. Great questions. Moving on now to Nita, Neta. First question here says, Hi Lance, hope all is well. Can you please explain more on how to identify a trade entry? How to identify an entry on the right side of the V?
Oh, those first two, George, I answered just on the
That's
channel.
right. Sorry, I
No
did
worries.
highlight that. So the okay,
No worries.
main question from this one was instead of that, what are your tips on how to recover from a big loss?
Yep. Yep. And this is actually funny. I mean, so first of all, I had a pretty timely tweet. Um, because so long story short, the beginning of last week, I was at Culver Academies talking to some high school students, some really talented, brilliant high school students. And one of them asked me, like, what was my worst loss? Not in dollar value, but just like what was the most difficult loss? And the truth is like all these losses and any big loss is so painful in the moment. But I think the way to think about it is like anybody that is a human. Like we've all had our struggles, we've all had our tough times. And it might have been not getting the internship, it might have been some breakup, it might have been getting fired from a job, it might have been a prior loss. We all have these struggles. And what ends up happening is if we persevere, like we end up growing, we end up learning, we end up being better, and we end up like every big mountainous problem in the rearview mirror ends up looking like a molehill. And so in the moment, recognizing that things are so much more painful than they will be over time, I think definitely helps. Um, I also have a video on drawdown best practices that I think really helps. You know, if you just Google Lance drawdown best practices, something like that. Um, and ultimately, though, like you can't change the past. The most productive thing you can do is like internalize the loss. There's no undoing it. And you know, like Bella sometimes talks about this, like there's a lot of Olympic coaches and team coaches where they'll be like, you know, you get 24 hours to complain and feel bad. After 24 hours, no more complaining, only moving forward. And I think that's not a bad thing either, because like you don't want to just ruminate and wallow in pity. You ultimately just want to learn what you can. And then even as like Ted Lasso says, like once you've learned what you can take away from the lesson, just be a goldfish. Like there's so many, just part of the job is you will take big losses. You do not want to ruminate on them. You don't want to give them more power than they need to be. And so I think, you know, learn what there is, write it up, put systems in place to make sure you're not going to make that mistake anymore. Then be a goldfish and just, you know, just keep on rocking on and looking to get better every day. You don't want to overly obsess over the outcome. Oh my God, what if I can't make it back? What if it takes me 1 month, 2 months, 5 months? You don't want to project. There's so many traders out there that are like, oh my God, this is going to be the end of the world. I'll never get out of this hole. Then, you know, sure enough, a month later, they're out of the hole. They're doing fine. So just don't project, focus on the process, learn what you can, and just get better. But it never gets easy. It never gets easy, but over time, we do have more experience just persevering through that. And ultimately, you know, that's what life is. There's ups, there's downs, and life is just how we kind of roll with the punches, grow from them, and just keep on rocking. So you know, it's not easy. And I have a video that touches on that on Twitter from I think it was last Tuesday maybe. So if you check like 3-11, I think I have a good video on this too.
Nice. Yeah. Yeah, Lance does have a great video on that. I would also say, um, check out the Mad As video Lance did on YouTube, which again isn't specifically this, but just my point to that would be, you know, make sure you're not using a system or in a position that could potentially, you know, give you like catastrophic losses. Like always have, you know, like guardrails in place, so that you don't end up in a position where it's like, oh my goodness, like it just seems unfathomable to recover. So great question there. Next one we have here is from John. It says, hi Lance, hope all is well. First question is, do you use order flow / volume or any third-party software?
Um, so I mean, I think what he's referring to is like there's a lot of third-party softwares now that will do almost like this volume you know type order book analysis. But no, I don't use any of that. And I think like you can just using your eyes in the level two, you can just replicate a lot of that. I'm not saying it's necessarily not useful. Like if it works for you, great. Like I could see like it's just a visual, a lot of that stuff, if I'm talking about the same thing, it's just a visual representation of the order book. And like, look, if that is easier for you, or if that's kind of what you've incorporated into your trading and it works, like great. There's nothing wrong with it. But for me, I've just been doing it the old-fashioned way, you know, with my eyes and no other additional software or anything.
Nice. Second question from John here is, do you focus on fundamentals / macro news?
Um, I wish I had a little bit more context on that. Like, I'm always trying to be as aware of news as possible. But like, am I focusing on the fundamentals per se? Like, big picture? Like no, like I don't, I'm not weighing the fundamentals in any of my trading decisions, if that's kind of the angle. um and like again, I'm very much aware of the macro news. You need to be in this type of market, you need to know what headlines are driving it, what's moving the market, and why. But Will I let the macro picture determine a trade decision? No. Not necessarily, but so I hope that helps. Like, yes, I'm aware of both of those in terms of just specific trading, but like not as far as like any specific trade decisions. I don't know if I said that well. Did that make sense, George?
Yes. Yes, I think it makes good sense. Yeah, it's a broad question. It's not,
Yeah.
I think that answers it well. All right, moving on here from Rick Alarcon. Two questions here. First one is, hi Lance, can you give us more concrete examples about having different playbooks for specific markets? For instance, for a ORB trade, I can take those short or long on what the market is offering me. So it's actually just one playbook. Does that one make sense,
Yeah,
Lance?
no, I mean, I think like, I mean, so ORB, I'm sure he's referring to opening range break. And so,
Yeah.
yeah, like, look, you know, are we are we in a bull market anymore? No, I think we all can agree on that. I mean, even just by pure technical definition, we're or sorry, we are bull market is bear market, we need 20% pullback. So like I misspoke there, but like, are we in a kind of strong bullish market? Like, no, I mean, look what the Qs have done. Like we've pulled back, I don't know, like over 10%, 15% in a couple weeks. So here's the thing is if the market is just melting like this, I don't want to be playing too many breakouts and moves to the upside necessarily. Like when the market's weak and selling off, generally a lot of stuff is going to, I'm going to try want to play more shorts than longs, more breakdowns than breakouts. Um, but to your point though, like most playbooks can just be totally inverse, right? Like if I'm playing an opening range break to the upside in a bullish market, I can just as well play an opening range break to the downside in a bearish market. If I'm doing like a bouncy ball type short in a bearish market, I can just as well do the inverse bouncy ball long in a bullish market. So that's like, so in that sense, like, yes, you're using the same playbook, but you're just flipping it. But I guess what I would also say is playbooks can change in ways beyond that, right? So right now we are in a market that is volatile. We are in a market that is very headline driven. So when those two things exist, you are actually disincentivized to take overnight risk. Why is that? Because in this market, there's a higher chance of randomness that you're going to get just steamrolled and very painfully steamrolled by an overnight headline or a tariff headline or a macro headline or whatever else. And so as volatility and headline risk increases, your time frame you want to decrease. Like a lot of people have been frustrated by the fact they'll be longer short a position, then a tariff headline will come out and they'll get run over one way or the other. And so essentially, like, yes, you can just inverse a playbook, but if you're like a swing trader or if you're like doing a ton of overnight risk, you want to then adapt your playbook and say, hey, I need to go much more shorter time frame. Another thing I mean is like, look, if you're an IPO trader, a lot of IPOs are potentially going to be on ice in a market like this. Even there's a Wall Street Journal headline that a lot of M&A due to this tariff uncertainty is also going to be on ice. Nobody's able to diligence and, properly value a business when you don't know what the hell's going on in the whole economy and it can change, every minute, right? So a lot of those playbooks are no longer going to be in play. And so that's what I mean about adapting different playbooks to different times. There's also times when low floats work amazingly well. There's times when I don't know. There's times when meme stocks are working well. There's times when a lot of sector ideas are working well. Right now, a lot of stuff tends to just be macro driven for the most part. But yeah, that's what I mean as far as adapting playbooks.
Very good. Um, let's see here. Next question from Rick is, for good breakout trades, do you just buy once the resistance is broken and see if volume comes afterwards? Or do you wait for volume to come in first and then you enter?
I do not want to wait for volume to come in. And this, I mean, if you watch the video, do I wait for the bar to close or similarly, what I might be, misremembering the title, but the one on do I wait for the bar to close? It's the same concept here. Like, why do I want to wait for all the volume to come in and for prices to push away? I want to be the volume buying at that breakout. Like, if this is a really good setup, I want to be buying that breakout. I don't want to be waiting for confirmation. So no, I'm never ever waiting for volume to come in. Pretty much, it would be very rare. The only times I could maybe think of an exception, because again, there's probably always exceptions to anything, but like the only exception I could think of is like if there's a headline that I think is a big deal and I buy, but then it doesn't go anywhere and it might just be needing some time to process. If it's like a really complicated or complex or slow to disseminate headline and I've already got an initial stock or maybe I got stopped out, for me to get back in or for me to add, there's times where I might wait for volume to confirm that like, oh wait, Lance, like you're right. This headline is a really big deal. It's just complicated or slow to disseminate. That's maybe the only exception I can think of where I would be waiting for the volume. Because in general, I want to be the volume. I want to be the confirmation. I want to be the person acting under the uncertainty, but getting the best, expected value compensation for that.
Nice. Great answer on that one. I think very clear too. Next question we've got here, guys, is from John Duff. Hey, Lance, wondering how you feel about hiding realized P&L during the day.
Yep. So I think this came up in another question as well. I think someone else asked this. So long story short, I'm just not a fan. Like P&L is a data point. And I think part of the job is learning to just handle the P&L swings emotionally. Um, and like the reasons why I'm not a fan of hiding P&L is like if I have multiple positions on, P&L is an indicator that helps me track whether things are working or not. So let's say the whole market pukes out, I'm long a bunch of stocks. Like I can tell from my P&L how well stuff is bouncing, even if I can't monitor all the individual positions at once. And then if for whatever reason, like my P&L stalls out, or if all of a sudden it goes from positive to green, like that alone is an indicator for me. Then the other thing too is like, I want to use my P&L to make sure I'm not also just making any bad habits. Like let's say, I have those give back rules on my daily report card. So if I'm up 25 grand in the first segment and it's slow, I might only want to give back 5 of that. In order to only give back 5 grand of that, I need to see my P&L and stuff like that. And yeah, I think so for all those reasons, it's like I kind of use P&L as a tool for just uh, you know, judging how well my positions are working, of course, monitoring that. But like, you don't want to trade the P&L. And I think like the whole reason to hide the P&L is just instead of doing the work it takes to just overcome those emotions at the end of the day. And here's the reality too. Like, look, calculating P&L isn't rocket science. Like, I'm fairly certain for most people, if you're trading a position, even if you have your P&L starred or blocked or hidden or whatever, you still have a pretty damn good idea of how much you're up or down, right? Like, um, take Tesla. If let me go to a if say for example, um, I short 5,000 Tesla right here at 239. If this goes to 237, like, look, it doesn't take a rocket scientist to know that, like, okay, like I'm up 10 grand on the position. So I'd argue even if I hide the P&L, this mental math isn't really that complicated to know your P&L anyways. Like so the real thing at hand is you just need to learn to handle the emotions, and it's a skill set that's part of trading. But you need that because then if you do have 20 positions and can't calculate your P&L, you need to know what's moving and what's not.
Yeah, great points. I love that point too about just because I know hiding it is something that some people are like really adamant about, others indifferent, but I think Lance has the most kind of intellectual response to it. But like he said, like even if you can't see it, your gut's telling you, or you kind of know where you are. I mean, unless you were to be managing a ton of positions, which in the case, I think it's more to Lance's point, like you need it there as your barometer for where where's the whole market going in terms of your position. So great answer. I think covers everything. Next question here is from Kitchens. Lance, could you tell us about what you did in times when your execution was suffering due to overcomplication and what the moments were along the way that led you towards simplifying your strategies?
Yeah, I mean, I think at the end of the day, if you're overcomplicating your trading strategies or your trading executions, it's just because you don't have a clearly defined playbook. Um, or that playbook needs to be refined. Like, not that this is the end all be all of an example, but let's say, for example, because I don't think this is that great of a consolidation. But let's say this was a much weaker consolidation. My entry is going to be this break of lows. And I might give it to the level, I might give it to prior bar highs. So I know based on my playbook, it's a pretty simple if then statement. There's no crazy complexities. And so like I know, okay, if we get back above this, I'm covering or whatever else. And so I think for the most part, like any overcomplication in execution, it's probably due to a lack of just clearly defined playbook. Um, because at the end of the day, most of the time when we execute, we are just following our playbooks. And if they're so complicated, I think we just probably haven't done the work to just say, like, what are the very specific moments I should be entering? What are the very specific moments I should be exiting? And what are the reasons I might call an audible? But yeah, I don't really think, and like, look, I've seen traders that they go, it's especially at SMB, there's a lot of guys that do a lot of like hedging with options and a lot of different options trades. And this is no shade on them. In fact, one of them is Shark, who's immensely talented, and certainly, as good of a trader as I am. Like, he does some quite complex options trades, but for me, I was never into that. Like a lot of times I'd rather just express it in the simplest, most direct manner. So I've never been a fan of this complexity or had that struggle just because I've got these defined playbooks and I'm not really complicating it via product either.
Nice. Let's see here. That was from Kitchens. Next question we've got is from Dawn Mamaril. Hi, Lance. In your highlight reel video, you mentioned looking for things we may have missed in the L2. Will you be sharing a video on how you read the L2? Also, will you be sharing your playbook? Many thanks, Don.
Yep. And I think this was all touched on last AMA. Yes to all of the above. Yep. Over time. Yep.
Yeah, yeah, that content is coming. Um, More playbook specific stuff is also coming. Next question we have here is from Rajan. Rajan asks, how does SSR affect how we might play a breakout? I suspect it would decrease win rate since people might be more inclined to short as we're breaking out, which may slow momentum. Wondering if this is a variable to consider when looking at breakouts.
Yeah, so
Um,
SSR that stands for short sale restriction, which is if a stock has been down 10% or more in the last couple of days, you generally need to get short by being taken on the offer rather than being able to hit the bid. So as far as breakouts, um, when it stocks in SSR, I don't overly think about it too much. Yeah, I don't overly think about it too much. I mean, I think like what can happen is there is a different dynamic on the level two box. Like it does change where you can get some stacking of offers and stuff. Um, but like no, if I'm getting long and I'm going to be net long, you then can hit the bid. So it's not some huge factor that I'm weighing overall, other than it does change just a little bit of a dynamic on the level two. But no, it's not some big factor for me.
Nice. Next question from Rajan's a two-part question asking about on March 12th, GV pushed into resistance and rejected. Is it fair to kind of think about this as a lower high post capitulation? So that's GV on 312.
Okay, yeah, I got that. Can you say the question again, George?
Yep. It says on 312, GV pushed into resistance and rejected. Is it fair to think about this as a lower high post capitulation?
Yeah, I mean, this was pretty far away from those highs. And overall, it's just been super rangy. So it's like, eh, I mean, the real high is all the way up there. So I don't particularly love this just because this is pretty mid-range still. Again, if we take the range being like, okay, um, this was at $1. We gap up. Geez, I mean, that's crazy volume. So like we gap up, this is almost like day one. This is day two, that's day three. So we go from like $2 to $10. Um, this bar is still pretty middle of the range. So generally what I'm looking for is more something like up closer to here. The other hard part is like, this did tremendous volume here. This volume, like I get that we're, roughly 3x higher in price, so you're not going to do the same volume. Um, but this volume wasn't so capitulatory. I don't know why I keep doing that today. So overall, like, no, it's not quite my favorite. I'd really want to see something much closer to those highs. And this is kind of, all this stuff in here. A lot of this is just pretty no man's landy for me because it's so mid-range. And I think all these what's so great about these AMAs is it just allows a cleaner uh, insight into just how I think about these things. And I think a lot of people probably underestimate how much I think about No Man's Land and the ranges. I spend a lot of time thinking about like, okay, like this is the whole range overall. Like this is the middle. If anything, I want to be short closer to here. I want to be long closer to here. A lot of this ends up wishy-washy, and like this came just so much into play and stuff like the quantums. Um, where a lot of people on this day one post the Jensen Huang comments at this oh God, what was it? CES, whatever the conference was. Um, so many people are thinking of a long one. It's like, no, dude, like we're just mid-range. Where you want to get long is when we stretch all the way back towards the base of this range. Where I want to, re-get short is if we're pushing up towards here. But like, shorting at 10 is mid-range. A lot of this is mid-range. Then as we roll over, we're starting to approach the bottom of this range now. So if anything, if I'm short here, I want to be much less short there just because look, this stuff can bounce around so much. So I spend a lot of time thinking about ranges, no man's land within them, and so yeah, I really want something much closer to 9, and not so close to the middle of the range.
Very good. Um, and Rajan message, we're going to skip the second part of that question. I think it was all answered in the first part there. So moving on to the next question. This is from James Ching. It says, hi Lance, I have a few questions regarding options. First question is, I know you mentioned that you will be having some videos on options coming soon, and you spoke about cash secured puts last AMA. Are there other strategies that you also use? What are your favorite options plays?
Well, I mean, like options are amazing in a lot of ways, and it's just a question of, I mean, there's just like an infinite number of ways to use them. I mean, like I used them last year in Micron. When was it? Yeah. Where like we had cracked hard here and like this was before its earnings and just the implied vol on the options. If I think I did a straddle where I sold a call and a put, and the implied vol on them was insane. So I've done that before. in stuff like SMCI, the exhaustion gap, earlier in the year, um, I did stuff like buying puts. There's times when I might sell calls. So I'd say like there's a lot of ways to use options. You can even use them as hedge plays, like I described before. Uh, it's more so given a chart and a situation and my expectation of what may unfold, that more so is what determines the strategy, right? Along with just the pricing of stuff, right? On this day, the puts were quite ridiculously cheap. So, and I thought the stock could just totally collapse. That makes me want asymmetry by longing puts. Um, like MSTR on that exhaustion gap, it was the puts were much pricier, so I ended up trading equity. On MU, both the calls and the puts were super expensive, so I sold them both. So it's not I'm not necessarily so super biased towards one strategy. I mean, oh, another great way is like, Apple on this $200 breakout. Like that's a great place to buy some weekly calls. Because again, we're doing a big picture breakout. That's where you can expect expansion. So it's not necessarily that I favor one strategy over another so much as finding just the right tool for the situation. The only thing I would say is if I do favor anything, it's generally been selling premium, and the reason for that is a lot of times I can just sell premium and I don't need to monitor it super closely. So just given my ability to, you know, the time I can put into the screens and monitoring stuff, selling premium is just a little bit of a more carefree way I can do it. So that's more based on just my lifestyle as opposed to, one thing being better than the other. Like I just think it's about finding the right strategy for your expectations based on the pricing and everything else.
Very good. Yeah, I know we've got some videos coming out on that stuff later. Second question from James here. Can you provide an example or two of how you would trade a mean reversion or breakout with options? And you might
Um,
have, I don't know if you want to.
sure. So, just simply taking this Apple, right? So $200 was a big daily level. Um, this had it was like essentially the news was, I think there was like a partnership with ChatGPT and OpenAI, rather than developing a lot of their AI in-house. We initially sold off, then the next day we reversed and just exploded on high volume. So on that $200 break, like we've got a news catalyst, we've got volume. That's something where it's like, okay, maybe I think this can really explode the next couple days. I don't remember what day 6-11 was. It looks like it was towards the beginning of the week. So that's where it's like, okay, maybe I'll just buy a weekly call, where you want to risk a set amount of premium. So that's how I might do it in a breakout. Um, in something like mean reversion, we can take Tesla. Uh, the implied vol was, of course, going through the roof. I mean, in just one day, the stock fell like another. This was what, a 14% down move or so. Implied vol was insane. We've made, kind of like, one leg down, consolidate, another leg. This was almost like the third leg down. Um, so when you get this price expansion and the implied vols expanding, and this day we get the capitulatory volume, we got the huge closing print, like I discussed. That's a type of day where I might be willing to say, hey, I think this is going to bottom, and if it goes lower, I might want stock lower to catch that bounce. So that might be where you sell. I would imagine this weekly $200 put was at least $5 if I had to take a guess. I would assume like the 210 was maybe like $10 after something like that. I don't, don't quote me on that. I'm just making up my guess. But that's the type of situation where I'd consider, selling puts for mean reversion. The hard part about buying calls on some of this stuff, the calls actually, I was looking at the calls this day, and it's hard because like the implied vol is so high. Where if you did catch this move, and hold it, you would have done okay just because of this gap, but you pretty much needed to sell. just because the ball was so high and then we didn't really follow through. So unless you timed it perfectly, you probably weren't doing so good buying calls on that.
Nice. One quick follow-up from the chat, Lance, is from Tom W. Says, how do you gauge mispricing of options? Regarding your comment on asymmetry on the SMCI exhaustion a year ago, I wonder how you could tell that the option did not reflect the probability or the magnitude of a second leg.
Yeah, so Tom, that's a great question. And so everybody here is an elite member. I have a 3 hour long video on the SMCI exhaustion gap, and I spent probably an hour tackling that exact question. I think the video is under the bonus content chapter. It's towards the bottom. If you just scroll down to like the bottom chapter or so, you'll see an SMCI charity review that's like 3 hours long, and you'll see a GameStop charity review. But long story short, I answer that in the most insane depth imaginable in that video, and I think everybody will find that extremely informative, and it answers it better than I can here.
Yeah, well said. Great video. Yeah, I mean, yeah, the depth on that one is incredible. Um, let's see here. Last question from James. I find it most challenging setting a proper stop loss for options. I wonder how you approach that.
Yeah, I mean, again, that kind of depends what strategy you're doing. Like, I think one of the beautiful things about options is, especially if you're buying calls or puts, a lot of times the beauty of that is it allows you to just risk the full premium. So going back to like that Apple, um, that Apple $200 breakout, there's a couple ways to trade this. Like if I buy calls, say I buy weekly calls. So first of all, I might want to just simply say, look, I'm buying these calls for maybe $2 or whatever the hell they were. Um, I'm willing to risk that full premium. I'm going to just close my eyes. Whatever happens at the end of the week, I'm going to take that. Or what you could do is just simply say, look, I'm going to buy these calls. If the equity gets back below the level, like below $200, I'm going to sell them. Um, but what I will say that I don't really do is I don't really use a price chart for a stop on the on options, meaning like a price chart of that option. So if I were to pull up like an Apple call, I'm not buying an Apple call at like 220 and saying like, oh, my stop on this call is $2. That doesn't really tend to align with how I end up trading these. Like it's more so I'm still basing it off the equity. Um, so essentially, for the most part, I'm either like okay risking the whole premium, or it's still the equity that's determining, um, my stop, for example. So maybe I'm trying to think of like, so maybe it's like, okay, take QBTS. Maybe yesterday or this was Friday, maybe Friday I sell a call, and it might be like, okay, I sold this call. If QBTS goes to highs on the daily, I'm going to stop out of the call. So it's more so I'm using the actual equity chart as opposed to like being super reliant on the pricing of the option itself. Drew asked, you can do conditional orders in IB, which is Interactive Brokers. So if the equity trades at a certain level, it sells the option. So yeah, so Interactive Brokers has some pretty awesome conditional orders in which you can say like, okay, if X happens in the equity, do this to this specific option. So you could say, okay, if Apple gets above 200, buy these calls using a certain type of order. And vice versa, I can say if QBTS gets above, X, close me out of these options or whatever. Uh, of course, it makes it a little bit tough, just if you're using limit orders because you don't quite know what the pricing will be. But yeah, overall, Interactive Brokers does have some cool stuff with those conditional orders. So thank you, Drew. But yeah, I'm definitely not just like basing it on the pricing of the option and saying, "Ooh, I'm going to risk 20 cents on this option." It's not really how I see those working so well.
Yeah, and I'll say too, just on the options piece, um, you know, you kind of have to go into those depending on what your strategy is or what you're playing, like that there is just that bigger volatility piece, depending on what your time frame is. So because I know I've seen a lot of people with issues with options where it's like they offer, you know, leveraged return, but there's leverage risk. So you have to, you know, take that into account where your sizing for options really might be truly different than for shares. So where it's got to be much smaller just because that risk can happen very fast.
Yep.
Um, so great answer. Um, from Lance here. Next question we have is from TD. Um, and TD asks, he said, are swings working in the current environment? I've been doing intradays only. Can you give examples of swings that worked in Feb or March? So I know this is a little tricky.
Yeah. Well, I
Um,
mean, I think this kind of touches on exactly what I was talking about before, where it's like, um, in this environment, I don't generally recommend that. And I think this question, this person's right to be moving towards intraday trading, right? For exactly the points I touched on. High level of volatility, high level of headline risk, makes that stuff super, super hard. So I would say what this person is doing by kind of adapting their playbook and moving more from swings to intraday is actually quite smart and is exactly what I would recommend. And like, no, like I don't think there's really been too many notable swings. Um, Otherwise, unless it's something moving super idiosyncratic. Like, but no, I don't think there have been too many great ones, which kind of further adds to that point. So I think what that question asker is thinking about and doing is in agreement with me.
well said, well said. This next one ties into this a little too. This is from Giuseppe LaBianca, and this is a little bit of a long one. I'll read it though. Says Lance, I'm trying to develop a framework for evaluating equity swing trade opportunities in the current market environment with tariff uncertainties, recession concerns, and geopolitical risks. So again, this is a lot that we've talked about. He says, what factors do you think are most important to consider when analyzing potential setups? I'm particularly interested in understanding how fundamentals might help screen for more resilient opportunities. Would you place greater emphasis on metrics like forward PE ratios, favoring stocks with more affordable PE multiples like Amazon as opposed to Palantir, revenue growth projections for the next 12 months, or cash flow generation capabilities? I've noticed companies with weaker cash flow positions seem particularly vulnerable. Also, do you think there's merit in exploring alternative markets entirely during periods of heightened uncertainty? I'm curious about your thought process rather than specific picks.
Yep. And so, I mean, I think this is an interesting question in a couple ways, and in which it's like, okay, do I have any interest in using certain fundamental criteria for deciding like some of these swing trades? In which I would say no, I don't. And the most interesting part of that is the question asker noted that stocks with weak cash flow positions have been faring worse. And so what I would say is part of why I don't need to worry about the fundamentals so much is because a lot of that ends up getting incorporated by the charts. And that's kind of the beauty of technical analysis is that I can just simply rely on the charts to tell me what I need to know. And so like I'm almost like, look, I don't want to be blind to what a company does. I do want to be aware about like their market cap, their like at least at a very basic level. But no, for no trading decision am I really doing any type of fundamental screen. Just because, as the person even noted, like the charts are speaking for themselves. And so then the question becomes like, okay, would I consider exploring different markets and other things? So I mean, like, yeah, like let's say you're a bullish, long bias trader, you do a lot of momentum breakouts and stuff. Well, guess what? When the cues are doing stuff like this, it's probably going to be a while before we get some momentum breakouts. So what you want to do is definitely explore other markets where it's like, okay, what are the markets that have been holding up well? Okay, we've got FXI, which is breaking out. We've got BABA that's breaking out. I'd be watching, JD. You can watch. Pinduoduo is still not that close yet. But I would just be watching some of this stuff. This Tiger, I have no interest in. Um, but essentially, yeah, like okay, what's been holding up well, and what then matches your playbook and everything else. So I do think it's smart to consider moving around to markets that are kind of matching your playbook. Yeah, absolutely. And as Drew comically said in the chat, as Kramer says, there's a bull market somewhere. And for the most part, that's true. And I think it's worth totally considering, like, okay, for my playbook and my strengths, where can I find more of those? Why be limited to just one area?
Yeah, great point. And I think everybody who's been watching the market knows that, yeah, the moves in China have been more bullish. So it's, I think it's a matter, like Lance said, of looking at the landscape, seeing where things are maybe moving to your type of trading, um, and then seeing how quick you can adopt to those ideas. So great point there. Let's see here. Next question we have here is from Shinatis. Says, hey Lance, on doing dynamic, and this is a bit of a longer one, on doing dynamic expected value calculation, I wonder how you operationalize this in real time. Do you actually calculate the distance to your price target, calculate the distance to your stop, do an educated guess at the probability of winning, and then apply the expected value equation and come up with a result? If so, do you do all of this by heart in real time? If not, what do you do instead to calculate the expected value? I'm trying to apply this concept to my trading and find it difficult to do this computation in my mind in real time. I also don't feel like doing it with a calculator is fast enough for real-time decision making.
Yeah, and I think we kind of touched on this last time, if memory serves correct. But like a lot of times, I'm just doing very quick mental math estimates, right? Um, so for something like this Tesla, if I'm potentially going to short this roll to lows, maybe I'm going to give it, this prior bar high. So I can, as this is happening, I can say like, okay, my risk is a point. Let's say I think this could go a symmetric amount and go, 6 points was kind of this range. So it's like, okay, if I think there's even I don't know. I think this is a reasonable enough short. I don't think it's amazing. This consolidation wasn't super great, but okay, like I don't think it's the worst idea ever. So maybe there's a 1/3 chance of it working. But if I think I'm only risking a point and this could go, say, 6 points or so, then I know like, okay, that's a decent trade. It's nothing super amazing. But just based on the math, I know that, it's 6 to 1 reward to risk. And I'm just estimating the win rate. And just based on that, I know it's at least positive expected value, but nothing so crazy. So this might just be, a B trade. I might risk, whatever. So I'm not doing anything super intense. Like, so what you didn't hear there, was I didn't say the low of this bar is 238.87. So you didn't hear, and the high of this bar is, oh God, let me see. 239.87. Oh, so that's actually 1 point. Well, okay, by pure chance that ended up just being $1 difference. But like you're not seeing me calculate within exact pennies the expected value. You're not hearing me say, $1.05 times 0.372 minus whatever. So I'm not doing crazy calculations. It's just mental math estimations. Um, so yeah, that's how I operate. I'd assume that's how most operate, honestly. I don't think people are doing anything so Rain Man-esque, nor do I think you can anyways, just because at the end of the day, this stuff is just rough estimates. So I hope that helps.
Yeah, and I'd say too, yeah, the more you practice it, um, the more you kind of internalize things quicker. And I think Alexander had a comment too that said, when you spend your weekends back testing new strategy, it's easier to calculate EV during the week. So, right, yeah, I think practice will definitely help as well there, to
A lot
internalize the
is a lot is
concepts.
practice, and it's like, I mean, if you were to take like if you were to take a golfer, for example, like say a golfer needs to hit across the water or they can lay up and like there's no way for them to calculate the expected value of each shot and on how many strokes it's going to be. All they're doing is a rough mental math calculation of like, look, yeah, I think 70% of the time I'm going to get it on the green. 20% of the time I'm going to get it on the rough around the green, and 10% of the time I'm going to miss hit it into the water. But, like otherwise, if I lay up, that's just definitely going to cost me an extra stroke. So therefore, I'm just going to go for the shot over the water. They're not doing, nobody on the golf tour is kind of busting out a calculator, but they're just making that rough calculation from experience. Yeah.
Yep, agreed. All right, next question here.
How many of these do we have left, George? Just because I want to make sure we have time for some of the rest of these.
I've been adding the ones in the
Oh,
comments.
you have been going through. Oh, from there. Okay, great, great, great.
Yeah, so but we're with ones in the comments, I think we have 8 left.
Okay, perfect. Good,
So
good, good,
I'd
good.
say we're tracking pretty well here, yeah. Um, Next one is from Michael C. This is a two-part question. Says first question, in your DRC from 2018, you created risk management rules such as reassess, soft lockout, hard lockout, and determining how much to risk for each trade, depending on whether it's an A, B, or C. In hindsight, was that risk management system a major factor in you becoming number one at Trillium? Would you have done anything differently today?
No, I don't think my risk management system was a big factor in me becoming number one. I mean, truth be told, I think potentially even without some of that stuff, I still would have been very, very good. And I don't think I have like exceptionally good risk management. I don't think my trainer had great risk management. I don't think I do. Um, but I do think what I did have is just a ton of edge. And when my edge was most in my favor, betting really, really big. I think those were the biggest factors for me. Um, what things would I do differently career wise? I mean, I think it's always hard to just look back in the rearview mirror because a lot of things just happened the way they do. I think the most important thing I would have advised myself, um, it's so easy to say, oh, Lance, you should have just increased way, way, way more size way sooner. But it's like, I don't know. It's way easier to just say that with hindsight when you can't just emotionally and psychologically do that so easily. But if there was an easy, I mean, none of these fixes are easy at the end of the day because I think you live the way you do for a reason. But I wish I didn't just beat myself up so much over big losses. Um, like early on, of course, the big losses are scary. Then throughout more of your career, you just doubt, am I still gonna just make it? But then once you've made it, a lot of those big losses, I would beat myself up so much for no reason. Where it's like, look, Lance, you're not gonna go hungry. You're gonna keep your job, um, and you just lose a lot of quality of life ruminating and beating yourself up. So I think, just going easier on yourself, learning the lesson, and moving on. But look, I could say the same thing today, and I would still struggle. So I think it's too easy to just be like, take breakups for example. It's so easy to look at past breakups and be like, oh, Lance, like, you just shouldn't have beat yourself up so much. There's always another fish in the sea. You're gonna meet them soon enough. But I think all of that is just way easier to say than when you're in the moment and you take some large loss or whatever else. Or I think it's so easy. Oh, Lance, it's 2020. You should bet, 100x, I think it's very easy to just say that now and always much harder in the moment. So I don't know if I'd do anything different.
Yeah, so well said. It's hindsight, just, you cannot really recreate that emotional moment and time period where you're dealing with things, trying to make decisions, and you kind of just have to be doing the best that you think you can. So,
Yeah.
um, well said. Next question from Michael C is, when you grade a daily chart and see a stock with price capitulation, price range expansion plus trading below its lower Bollinger Band, but without volume expansion or volume capitulation. Would you still keep it on your watch list for the day despite the lack of volume expansion, or does it become uninteresting since the volume isn't increasing? And sorry, I read that a little weird. Let me know if I need to reread that.
I mean, so here's the thing, like for me to add a ticker to my watch list over here, it literally costs nothing. Like so not a big deal to throw in a limit alert or to have a one share tracker or to add it to the watch list. Like there just isn't any cost. So like so often I'm just throwing stuff on watch lists all the time. Like, who cares? It's just not a big deal to look over it. The way bigger, more costlier thing is to not add something to your watch list. Then you end up missing an opportunity that ends up setting up later. And then you end up just feeling real silly. And so, in general, it's like, look, like it's not going to be some unwieldy thing for me to type up through a bunch of these stocks or have limit alerts or just all types of different alerts in. So for the most part, it's like I'd rather have kind of too much information coming my way rather than just miss an opportunity that might set up later. So I don't think it's a big deal to be adding stuff to watch lists and taking off if it then changes.
Nice. Yeah. So good point. Just, yeah, better to just keep that there than potentially miss the opportunity. Next, next couple questions here from Roberto Claro. Number one, Lance, you talked a couple times about a concept that you called technical geometry in some intraday setups. How do you understand this? How do you understand this concept better and apply it properly in our trading systems?
Yeah, so I mean that's something I'm going to do a video on too. That's one of the things I'm most excited for. What was it? GV, that was one. So here's the thing, right? What I mean by some of that geometry and all that is like if I short this bar, the risk to highs is quite a lot. It's if I short it around here 730 or something, it's $2.30 when my expected reward on here is pretty minimal. Like I don't know, like for me to make $2.30, it's brings it down to about $5. Like I don't know, it's okay. I don't love it, but here's what, guess what? If this bar went all the way up to $9, then all of a sudden, if we capitulate intraday up to 9, my risk all of a sudden is 60 cents, but my reward might be $4. So all of a sudden, the expected value, obviously the probabilities will shift as well, but the expected value is way, way, way more appealing to me. So that's why the geometry of these charts, as far as retracements and everything else, are really, really matter. Likewise, let's say all of a sudden we could stretch this chart up another 5 points. If we could stretch all this up and there was an even bigger range, then that would mean the reward is even more appealing, yet the risk stays the same. If all this was just if all this just shifted $5 up, the reward would be increased, risk would stay the same, expected value is better. So that's kind of what I mean by the geometry of these charts. There will be a video on this. It's quite technical for me to build the graphics out for this one, which is why that's taken a while. But that's also why that video is going to be just so important. And also the way these bars form, like also as far as geometry, say I'm doing a prior bar lows system and I short, we break prior bar lows here. So I short at like 550 on 3-10. The way this has this crazy wick, because of this crazy wick, if I short at 550 and I'm giving to prior bar highs, my risk is 4 points. There's no way I'm going to make 4 points on these shares pretty much. So that's what I would mean by the geometry of these 4 bars set up really, really bad for a swing short. So that's what I mean by some of the geometry of this stuff. Like now imagine, let's say this bar, the lows were at $9 and I shorted the break of lows at 9. The reward could have been points while only risking 60 cents. So that's where the geometry matters, but I'll do a much more professional job of explaining this over time.
Yeah, just while we're on GV there, Again, Lance, Rajan had one follow-up, saying regarding his question on GB earlier, said, we had intraday resistance around 8, and on 312, we pushed aggressively to that level off a catalyst. Also, I think the range was from 1.2 to 9.6. So pushing towards that level is still the top portion of the range. So does a right side of the V intraday play there make sense?
Let's see, it's 312. 312, 312.
And I can unmute Rajan here if you want him to explain it a little better.
No worries.
Okay.
So this kind of, yeah, so I mean, it's okay. Because I mean, at the end of the day, like, yes, this is pushing, yes, this is pushing higher overall towards here, but yeah, I mean, it's not the worst. I can see the point. 'Cause that is a pretty damn decent move overall. Um, yeah, it's not the worst idea, honestly. Like, I still wish this was a little bit higher on the range, you know, because it's still not that high up on this range. But yeah, it's not the worst. Yeah, I see all that. It's definitely worth watching and considering.
Very good. Yeah, hopefully that answered your question, Rajan. Roberto's second question here was, you've been giving amazing advice about how to deal with losses and bad times. How about dealing with success? How do you avoid self-sabotage and stick to the plan and fight that invincible feeling that shows up when you're doing things right and results finally start to appear? Great question.
Yeah, I mean, I think one thing anyone can agree on, or everyone can agree on, is like it's way better to deal with success than to deal with failure. I think that's like the way more enjoyable thing to deal with. But I do like at the same time, I don't think that's like a stupid question. Like I do think a lot of people tend to get overconfident. A lot of people tend to oversize. I know this is something that Austin Mitchum of Australia has blogged about and written about. I know this is something that Shark has struggled with. I know this is something that I've struggled with. And so I think what's most important is you always want to just handicap the trading day independently. Um, like especially if you're a pretty experienced trader, like you want to give each day the risk that it actually deserves based on the quality of the opportunities. So if like a really good if I'm on a if I've made 20k 20k 20k, but then the next day the opportunities are just really slow and there's nothing that good, I still shouldn't try to make 20k just because I did the other days. Like I really want to try my best to independently um risk what I would regardless. Like, so it's just a question like what would I be risking today, or what would I be risking on this trade if I wasn't on this positive streak or whatever else. You really want to try and just stay as objective and consistent as possible. And a lot of that might just be like, you know, I know traders where if they're on a 3-day win streak or a 2-day win streak or a 5-day win streak, or I know traders that after they have their best day or a really good month, they have to set reminders and alerts. You know, just kind of like memento mori. For those of you that don't know memento mori, I think it was what like the whole Greek phrase where I think it was for one of the rulers or someone, you know, they had someone that followed them that just pretty much said, you know, remember you're mortal, remember you're mortal, you know, you too, you know, can die or whatever. And essentially like it's just that reminder like hey, like you might be on a hot streak, you might be making a lot of money, but you're mortal and you can f up bad and it only takes 1 second. So a lot of traders like Austin Mitchell, myself, we've implemented rules where it's like I know if I'm on this type of hot streak, I let my guard down. And then it's just being very conscious and issuing rules and also sometimes tightening up the risk. So one thing that would always happen for me, similar but different, is ahead of vacations, I would always let my guard down. So whether it's positive streaks or whatever else, you need to just be very careful. And one funny story actually, I think it was in like, I think it was in spring of, was it 2021 or I think it was in 2020, maybe in like April, May of 2020. I was on this epic positive streak. Like it was my greatest positive streak in it was in magnitude, it was just millions and millions of dollars. And it was like, I think like 60, 70 days green in a row, which is unheard of for me because I just am not that consistent. And every single day I went into work, the only thing I was thinking about was like, Lance, don't force this. And if today is today, if today's the day you're red, just have a good fail. And what does a good fail mean? Like this even happens in lifting. Like if you're going to fail on like a PR attempt, you just don't want to get injured, right? And so you don't want to do anything dumb and you want to be very conscious that it's like if you're going to fail, you want to bail properly. And so during those days, it was like, Lance, like it's totally okay to be red. And I ended up ending my positive streak with like a minus 20K day, which was not a big deal. And that was a good fail. And I was immensely proud of that. And I was very conscious of allowing that to happen and not fighting it. So I think all of those things help out with that stuff.
Nice. Yeah. Great. Great point. And I know for most people, it's like, yeah, just being in a positive streak alone is incredible, but there are the huge risks. When you work hard and you get there, that overconfidence can crush you. No question. No question. So, very important question. Next one here is from Shanatus. Says a question on current market conditions and how to navigate this. Since mid-late February, the market became bearish and my momentum breakout strategy stopped working.
Mhm.
So I'm sitting in my hands right now, not trading anything. I would love to expand my playbook to be able to trade in a choppy bearish market like this. I wanted to look into what you did in 2022, but found limited resources. My questions are, in general, what do you recommend a trader do in a market like this? What are some of the setups we should study and apply during this time? Are there any specific periods within your DRCs that we should take a deeper look into that you think are applicable to the current conditions?
Yeah, I mean, so first, I think this is just a great observation by the question asker. And it's exactly what we had been talking about for a lot of these bullet points at this point. And so there's a couple things, right? Like, okay, so the market's becoming more choppy and different from our playbook. And so there's a couple things you can do. The first thing, and really one of the most important things you need to recognize is that not trading and not participating is always an option. Like, yes, we are traders. That does not mean you need to trade every single day. There are so many traders that are totally okay sitting on their hands, waiting for their market. At the Traders for a Cause happy hour last week, I met some traders from 7 Points Capital, and one of their really good traders that was there. Um, he highlighted that his strength and his superpower was just sitting on his hands. He's very selective. He really almost never draws down because he's just sitting, waiting for that exact moment where everything he's looking for lines up. And then it almost is always working in his favor, almost never draws down. And so the first realization we need is like nothing forces us to participate in a market that is not right for us or that we can't do well to capture. So that's like the most important number one. The number two thing that I would say is like if we are sitting on our hands, of course we do then, much to the credit of this person, we want to be asking, can we expand our playbook? What plays are working? And so in general, I would say like as touched on earlier, one of the things we want to do, of course, is lower our time frame. Swing trades you're not going to have fun with in this type of market. You do want to lower that time frame. You do want to focus more on intraday. But other than that, I think like a lot of this stuff has been more difficult. I think in markets like this, breaking news still performs very, very well. I think like uh, monitoring levels in the market and trying to find those market trend days work well. Let me turn off this on demand. So like if we end up consolidating, then rolling over, like a roll below 550 with proper consolidation, I would definitely be looking for. I would definitely be finding a watch list of what tickers can't bounce, what tickers aren't bouncing well. I think it was equally smart to find what tickers held up super, super well during like this, like we touched on Baba. So I think finding the strongest stocks that held up well and are breaking out now are great. I think finding the stocks that, can't bounce so well, should this, roll over along with the market is going to be interesting. So I think all of those things we can do during markets like this, but most of all, nothing forces us to take subpar trades. This is not baseball. You do not need to swing. This is not poker. You are not paying blinds or an ante. So like never underestimate the ability to sit on your hands in tough times. But yes, of course, while trying to learn and observe and expand the playbook too.
Very good. And we've got, I think, 4 or 5 questions left here. This next series of questions from Sahil is a little long, and some of these are pretty basic, Lance. I'm going to recommend to Sahil. I think some of those were answered in the Ask Lance Anything section. Just for example, Sahil says, I'm new to stock trading, so forward testing some concepts that Lance teaches are important. I know you mentioned only 4 to 5 stocks meet the broken slot machine concept on a daily basis. How do we filter for those? So those are some things we're not going to cover now. Um, 2 main positions I learned from you are impulse breaks and consolidation highs. Again, those are playbooks. But a couple specific questions Seal had that maybe make sense to answer here, Lance, would be, says, can you go over NVIDIA and Tesla on 310 and show areas where you would take the largest position trades or trades you would take in general? Um,
I mean,
I don't know if that
already
is,
just looking at this, I'm gonna guess there's not much, especially on the Tesla or sorry, the Nvidia. I mean, so
yeah,
Nvidia here on 310 is just in a downtrend and weak. And I don't think there was anything this day that interested me. No, there's nothing that interests me. I think this move, the only move that I liked this day was not stock specific, but it was just the Trump headline that he was doing more tariffs that caused I think that was the whole market.
yeah,
Or
could have shorted the whole
the
thing.
whole market kind of then started to roll over. Um, Oh no, that was the next day. Oh, but yeah, so the Nvidia I had less interest in. This in Tesla, this break was a little bit interesting. Just because this was such a weak move, we can't bounce at all. We try and get above this 242 range, can't go anywhere, then we roll over. So this spot after like these okay, so and remember what I talked about that 1-to-1 size of leg to consolidation, right? Like I'm not going to draw it because it's just annoying. But this was one, this was kind of the size of the leg. We went to symmetric consolidation. So that's exactly what I'm talking about, right? I know you guys can't see my fingers on the screen, but like it's pretty much the exact same distance, right? If I were to take a ruler and measure here to here and there to there, it's pretty much the exact same distance, just eyeballing it. One funny fact is the eye is actually like super, super good at spotting symmetry and estimating stuff like this. Um, but so yeah, this rollover is pretty interesting to me. Um, even this is a worse consolidation, but and it's so close and we've moved so far, so I don't think I would go for this one. So it's not the worst thing ever, but yeah, mostly this spot there is interesting. Nvidia, no interest to me.
All right. And then a few other quick ones from Sahil here. This is just a basic one. Are there any times where you tend to avoid trading? Sahil says, I notice around 11:30 a.m. to 1:30 p.m. This is he's talking about Central Time, so that's 12:30 p.m. Eastern to 2:30 p.m. Eastern is kind of dead with regards to volume. So I don't know if you have a
Yep.
comment on that.
Yep. So I think time of day is absolutely a super important variable, especially for breakouts and breakdowns. Um, so I would say the most common continuation pattern is a stock makes an opening drive either up and down, up or down. We, maybe call from 9:30 to 11 or so. We then consolidate midday roughly from 11 to 2 or 11 to 1. And then in the kind of later afternoon, we then break out and have a second continuation leg. So I would say absolutely, I do think midday uh breakouts or breakdowns have a much lower chance of continuation. So I would say that's totally true. I would say it's not true though for breaking news. Breaking news headlines can happen, of course, at any time, and I don't think their impact will at all be softened or stifled by time of day. So yeah, I think that sums it up.
Very good. Last one from Sahil here that we're going to look at um, is, and he just put in the chat, let me get back to that. How do you tend to weigh pre-market action? Are those levels you tend to carry over to market open? Do you avoid the first 10 minutes of market open due to volatility / unclear direction?
So, I mean, a lot of pre-market stuff really depends like the volume and just how good of a level there is. Like all of this volume in Nvidia pre-market this day, it's just like a rounding error compared to the actual trading volume. So like, if something's doing like a couple lots or like an odd lot or there's just huge gaps in the price action, like I'm not really going to view that as super material. So it's kind of an art just relative to the actual volume that's happening and just how clear the level was. um like whatever this little wick here is at like 111.70, like nowhere would I ever buy 111.70 just because there was this little wick at like 4 a.m. Like all this volume here is literally nothing. um but there's stuff that's moving pre-market on news, and it really does have real levels and real psychology behind them. So I think like the more volume and just the more cleaner the level is, the more appealing it is to me to find relevancy during the trading hours. And do I avoid the first 10 minutes off the open? No, definitely not. Um, you get some really nice trends off the open and you can get some really nice moves. And it really just depends the quality of the setup and the situation. But, I think sometimes things can be a little whipsawy. But no, I definitely, a lot of days am quite involved, off the open and don't avoid that.
Very good. Last few here, and then we've got a couple in the comments we might get to as well. Another one from Giuseppe says, what indicators, if any, do you, and I think we know the answer to this, do you find most reliable for identifying true oversold / overbought conditions in intraday trading? And have you ever incorporated the Connors RSI or similar composite indicators into your methodology?
Nope. I've dabbled with RSI. I've looked at some of these things. For the most part, though, I just use Bollinger Bands. Bollinger Bands, volume, price. That's about it. I might use a 50-day moving average, 200 moving day, but at the end of the day, some of like the RSIs, like, I mean, I won't totally discount it. Like to each their own. But there's just limitations to how many indicators you can factor in and everything. Um, so like I'm not against RSI or any of this other stuff, but I found what works for me and I just don't overcomplicate.
Yeah, and I know that, the thing about RSIs too is that there's a point where those just break down, and especially when something's trending strongly is where the RSI just doesn't really function. It's kind of like it can just continue no matter how low or high RSI is, can continue to go to a point where it's beyond extreme. So
Yep. Yeah, and
that's
Drew just asked, Lance, you use VWAP though, right? Yeah, I use VWAP too. I'm not like obsessively, but I think the original question was in regards to overextension, in which VWAP being the average price, it's not so. I don't know. Like I'm not taking distance to VWAP as opposed to just the Bollinger Bands and the moving average. Yeah.
Yeah, and that just answered Giuseppe's next question, which was regarding VWAP and anchored VWAP. So we'll go on now.
Yeah, nothing wrong with VWAP or anchored VWAP, which Brian Shannon kind of, pioneered. Lot of, Brian Shannon, super nice dude. I use these things. But yeah, nothing, mostly depends the context of the application. And, VWAP I mostly use as just a very basic definition of trend. I touch on this in the defining trends video. So yeah, I use these, but there's no I think I even have the video, there's no magic indicator. And like, look, if RSI works for you, like there's times where I'll sometimes pay attention to an RSI where it's like, oh my God, like this is one of the um, you know, largest RSI, most overbought, most oversold, whatever. Um, yeah.
Yeah, and I'd especially say, yeah, when things are in conjunction, that's another big point is just if you have multiple layers working together where it's like, yeah, super weak RSI, way below VWAP on whatever time frame, I think all that can play congruently really well. Next one here from Shanatus says, hello, Lance. In one of your interviews you had with Jonathan Sheraton from Trillium, Jonathan mentioned you're opposed to the idea of hiding the real-time P&L. Oh yeah, this is that second one that we talked about. So we already answered this, I think, pretty clearly.
Yep.
Next one, this is from Vanessa. Hey, Lance, I've been looking at strategies that, like you suggested earlier, are not correlated with the market. One play I'm working on is short squeezes. Can you recommend another non-breaking news play that you find to be not correlated with the market?
I mean, I think just simply finding stuff moving idiosyncratic to the market, as touched on, stuff like BABA. This is clearly not moving with SPY or QQQ. So I think finding any technical setup, just idiosyncratic. There's a lot of stocks that are just not going to move so correlated, right? So I think that's one way to just kind of break the mold on some of that stuff.
Yeah, well said. Well said. And that was the last official one I had written down. I think we had a couple more come in through the chat that I didn't put down.
Mhm.
So we'll hit those real quick. One Lance said, would you have taken Tesla on 227 at 10 a.m. when it was overextended but not capitulated? And then they threw out another one too, but maybe
Let me
look at that one
see. So
first.
227. So I mean, again, for people, new, I'm always taking the context of the daily. Yeah, essentially we rolled over below 325 or so. Big down day, smaller down day. So the down days had been getting smaller, which I in general don't like. So then the question was on 227 at 10 a.m.
Yeah, 227 on 10 a.m. They said 2-minute turn when it was overextended but not capitulated.
Like, so this is one of those things where like the daily I'd maybe give like a B, because those bars were getting smaller. Maybe B plus, just because it was a lot of down days. And so this intraday, I would also give probably like a B, maybe B plus. Like I do like how we kind of did this drive. Like, this was probably like an 8 point drive. Um, we then fail. And so then we go like a pretty symmetric, 8, 9 points below. So, I mean, and this was, if anything, even bigger than what we were above. So we hold prior bar highs very, very cleanly. So would I consider buying this turn? Yeah, I think like overall, we have like a B plus daily chart and a B plus intraday. I mean, maybe this intraday is more of like a B plus than a B. So yeah, I don't love this, but I don't think it's wrong doing, you know, some risk here. I definitely could have seen this bounce pretty damn cleanly. So yeah, I don't think there's anything wrong with this. So then the other one was 228.25. 228.25. Oops. Oh, that was just the next day. Then the first 5 to 10 minutes. Yeah, I mean, this is going to interest me a little bit less. Just because the move's so much smaller. And let me see this daily one more time. Was 228. Yeah, I mean, it's the appealing part, the more appealing part of 228 is just that it's another day, it's just another day down. Um, but you know, the intraday wasn't so great. So I don't feel so strongly about either of those spots. I don't think they're bad. Like I don't mind a little bit of risk there, but no spot am I like, oh my God, those were amazing.
Very good. I think we're down to the last couple here. Um, let's see here. So one other question from Sahil was in regard to like filters. I think filters and scanners is his question. Said, can
Mhm.
you provide me some resources I can go back and look at to filter in the future? So I think just filter looking for setups.
Yep. I mean, I think so. And I'll have a video on at some point on this. So stockfetcher.com is an awesome resource. You can do amazing just daily chart filters on that. Super customizable. It's not that expensive. I think it's like 100 something bucks a year. So Stockfetcher is awesome for daily chart filters. As far as intraday chart filters, there's only three main scanners I was kind of running. I was always looking at what stocks were doing the most volume as a percent of their ADV. I was also looking at stocks up the most on a percentage basis and stocks down the most on a percentage basis. So those combinations of filters actually get you a very long way. And from there, you can kind of, you know, um, handle it from there as you see fit.
Perfect. All right, last official question we have, and sorry, I'd missed this one from Jean-Luc. Jean-Luc says, hi, Lance. If I have two strategies with the same expected value, but one of them has a large tail risk, how do you allocate capital between the two considering this fact? Also, in the context of exponential bet sizing, isn't it harder to go very large on a strategy that has very good EV but low batting average?
Yeah, I mean, so I think like all of that is true and worth thinking about. So like if a strategy has a tail risk, you generally need to size it much smaller. You know, like think God forbid, but like you know, the game, if you were to do 1,000 bullet you know, roulette, Russian roulette, like in general, like I would never, you know, if the cost is your life, I would never ever take that risk, no matter how small it is. And so if the tail risk is really massive, and it's the question is one, is that tail risk acceptable to you? Where do you even want to play that game? Take for example, you want to know a good example for this is shorting some of those Chinese low floats that were doing like the Widowmaker gap ups, like the ZJYL type one. So it's like even if shorting those in the aggregate tends to work, if you're taking on massive tail risk, like do you necessarily want to be involved in that at all? My personal opinion was no, because that could just be career ending. So especially on the shorts, I think career risk, or sorry, I think tail risk is quite dangerous. And so of course I would then want to size it way smaller. Then also in the context of exponential bet sizing, isn't it harder to go very large on a strategy that has very good EV but low batting average? Yes, absolutely yes. Um, you know, if you were to take something like you know, the private equity model, In private equity or in angel investing, even more early stage, your batting average is very, very low. In angel investing, maybe you get 1 out of 20, 1 out of 50, 1 out of 100. And so as a result, you can't be an angel investor and really just split your money across 5 plays. If you do that, you're not going to be an angel investor very long. So yes, the lower your batting average is, um, even if it has very good EV, you do need to bet way, way smaller. So yes, that's very astute. Yes, I agree with everything you wrote. And I think just asking those questions shows like a fair amount of just insight and intelligence to be thinking about that. So yes, wholeheartedly agree with that train of thought. It looks like
Right.
what, one more.
Yeah, I think one more from Jason there, Lance, and that's probably the last one we've got.
Perfect. How do you generally manage re-entering on breaking news when the move takes time to disseminate? Hopefully not seminate, because I think that might involve semen, which is not appropriate for these channels or AMAs. Uh,
Mm.
Example, the Citron research report on GRRR. No worries. Um, so I think in general, I'll have stuff like there's going to be times where stuff doesn't necessarily go super well initially. And so I might then have like, okay, if I miss the initial move, how can I get back in this with good EV? So a lot of times what I look for is potentially a roll to lows. And so this, I don't particularly love this price action here, but like a lot of times anything with a short report, like we saw this with MSTR, we've seen this with a bunch of names. A lot of times short reports can really just gain momentum and then just like epic melt later on. So I'll generally be looking for a roll to lows. In the case of GRRR, like I saw this today. I really didn't particularly love anything. But I do think with a lot of these short reports, there's times where once you kind of break the initial lows, these can then start to roll over. And like, I don't find it uncommon that some of these hold a moving average and super, super melt. Um, let me check something real quick. I want to check this APP. Bear with me for a second. Because this was, I think it was on this 2-26 day. This had the short report. I mean, this had a couple short reports, but bear with me real quick. Um, Sheesh. Yeah, this melted pre-market. Um, yeah, so this did most of the damage pre-market, or this then rolled. Yeah, so I would say in general, on some of those short reports, I'm looking for a roll if I miss the initial move where it takes a while. Um, then the other question, and that's also, Jason, where like the quality of the consolidation and the quality of the role is very, very important to me. So I think a really good project is to database a lot of those examples where it's like, okay, this was slow to disseminate, like, but hey, overall this caught momentum. This is what the rollover looked like. So I would be studying like, do these tend to hold the moving average? Do these tend to roll later? What I do find is that if something has a short report, then later on in the day it breaks to lows, it's very, very much worth watching and keeping an eye on, because sometimes those just take time. Um, so let's see. I think I saw. Then there was one other part. Any possibility of having a closed community chat in the course app for the elite members? Um, so actually there are a lot of those chats are elite member only. There's only like 2 or 3 that are public to everyone. So most of those are actually for elite members, a lot of them. Advanced or elite. So the other thing too is hopefully within a couple weeks to a month, we will be doing that Discord set migration. So in an ideal world, a lot of that is going to be a lot smoother. And essentially what we're going to do is just import a lot of the member lists. So it will also again be segmented by tier. So yes, so yes, already a lot of those are advanced or elite only. And yes, once we port over to Discord, if all things go well, it will continue to be like that. Yes.
Yeah, the Discord, just to touch on that too, the Discord migration will be huge. I mean, the features that we have now will just be exponentially higher. So that will, I would guess within a month's time, we'll have that at least launched and live. Yep,
Awesome.
and I think that is everything, Lance. Great session.
Yeah, guys. So, everyone, thank you so much for the amazing questions. Thank you so much for the support. As always, we've got a lot more content coming. So, just keep it up, and we're just going to keep on doing our best. We've got the Android app, we've got the eventual Discord migration. I'm hoping to announce another meetup, hopefully for April if I can pull it off. So, a lot of good things. Real quick, actually, let me end this recording there and then I'll ask you all some questions. So thank you all. We're going to end this here.